Look, we're confident of delivering against our capital allocation framework, which would see a payout in the range of 25 to 35%. And we also anticipate that some of the benefit of the strong cash flows, particularly from Kestrel in the second quarter, will come through into our free cash flow in H2, which should therefore translate into the H2 dividend.
Hello, you're watching Proactive. I'm joined by Ecora Resources CEO, Marc Bishop-Laflèche. Marc, very good to speak with you this morning. You're out with your half-year results. You must be pleased with the portfolio contribution up 15%. Could you talk us through some of the highlights?
It's a great start to the first half of the year. Really strong portfolio contribution, as you mentioned, coming in at approximately $52 million. That was really primarily driven by Kestrel volumes, large amounts of Kestrel volumes being mined in our royalty area in the first half of the year. We don't actually expect mining substantially to be in our royalty area at Kestrel in H2. Nevertheless, though, the volumes we've seen in H1 have come out really at the top end of our expectations and guidance for Kestrel for this full year. So it's a good start there. What we've also seen in the first half is some of the key milestones at Voisey's Bay being achieved. That puts us in a great position with a great line of sight on a big ramp up in H2 of this year and towards the end of 2026 as that asset really hits its stride. Elsewhere in our portfolio, Capstone Copper released an updated feasibility study in relation to the Santo Domingo project. That study confirmed the project's robust economics, but also importantly, confirmed the project as a potential low-cost producer of copper of approximately over 17 mine life at a cost of 33 cents per pound on average, which positions this project as being amongst the lowest cost, fully permitted copper projects in the world. So that bodes well for our future copper exposure and for our medium-term growth. Having said all that, the share price performance in the period was extremely disappointing. We're trading at a sizable discount to our net asset value, and actually today for even less than the estimated asset value of our producing assets. So from here, we're really focused on further growing and diversifying business, particularly the income profile around some of the cornerstone assets we bought recently. And the board and management have continued to recognize the value opportunity via share purchases.
Your net debt leverage looks comfortable at less than 1.5 times. Does this give you scope to make further acquisitions in the near term? And what sorts of opportunities are you looking at, Marc?
So we ended the period, as you mentioned, with net debt at approximately $86 million. And looking in the next 12 to 18, 24 months, portfolio cash flows, absent acquisitions, should see that come down meaningfully. On the business development side, interestingly, we've seen a big uptick in opportunities to further grow the portfolio in the last 6 months. And we're reviewing those and we'll continue to review them in line with our stated investment criteria. That doesn't by any means mean that any of these will translate to executed deals, but we are certainly seeing a good amount of potential deal flow. And more generally, when we think about capital allocation, one of the key priorities of that framework that we announced earlier this year is to prioritize both growth, but also the maintenance of a very strong balance sheet. And so any acquisition will be evaluated within the context of those two key priorities.
You paid another dividend towards the upper end of the payout range. Are you confident of delivering another strong payout for the full year dividend?
So this is the first dividend that we've announced within our new dividend framework. Came out at 1.7 cents per share, and that's approximately 33% of free cash flow during the prior two half-year periods on average. The formula that we came out with actually was intentionally designed to try to smooth the dividend, as we may see some fluctuation in half-year periods around cash flow. For example, we see Kestrel this year being primarily weighted to H1, before returning to our royalty area in the first half of next year. So, look, we're confident of delivering against our capital allocation framework, which would see a payout in the range of 25 to 35%. And we also anticipate that some of the benefit of the strong cash flows, particularly from Kestrel in the second quarter, will come through into our free cash flow in H2, which should therefore translate into the H2 dividend.
Perhaps the one blip in the first half was news of BHP's decision to suspend construction of West Musgrave. What impact will this have on Ecora, and what do you think the future prospects are for West Musgrave?
Well, any way you cut it, it's disappointing. I think when we look at the nickel market today, weak. But then on the flip side, this asset was expected to be able to, from a cash cost perspective, should be able to run profitably and generate strong cash flows even in today's weakened nickel market. That's certainly helped by the fact that at spot prices, 40 to 60% of the asset is copper. So certainly disappointing. But nevertheless, we do remain very confident about this project's potential. It's a low-cost project, as I mentioned. It's fully permitted. And I think when we look ahead, BHP's commentary that they see this the nickel market, tightening in the next half of this decade, and therefore be a key beneficiary of what BHP continues to believe is the electrification megatrend.
And the full year results, you were forecasting year-on-year production growth in both 2024 and 2025. Is this still the case?
Yeah, absolutely. I think based on the entire portfolio performance in H1, and as I mentioned, we don't anticipate much from Kestrel in H2. But in any event, when we look at this on a year-by-year basis, from where we're tracking, we continue to expect some volume growth in 2024 compared to 2023, and then again at 2025. In the second half of the year, the big driver should really come from Voisey's Bay. In the first half of this year, we received 4 deliveries. From where we are today in early September, in the second half, we've seen 1 delivery already received by Ecora. 1 is at the port, and 2 are expected to ship imminently. So we should continue to see some step up in Voisey's in H2, but again, in 24 and 25, 25, 26 thereafter. And then our short-term focus really in terms of how do we is around further infilling and diversifying some of the larger cornerstone royalties we put into place, such that we're better able to, as a business, be less impacted by some projects if they move forward or later, or just less concentrated in any one asset. So we look forward to updating the market on our progress in the months ahead when we next speak.
We look forward to those conversations with you, Mark. Thank you very much for taking the time to speak with us today.
Pleasure.
That's Ecora Resources CEO Mark Bishop Lafleche.